S&P continues to be wedged, but we got some color here on what exactly is going on. And that color is red. We have a major panic going on in the regional bank space, but is it warranted? Despite everything going on, the NDX 100, NASDAQ 100 dropped last Friday and hasn't even retouched that level, leading people to believe that it's just a blip. But we are seeing a rotation. That rotation is in biotech, and now we're going to discuss whether or not it's warranted and how selective that rotation is going to be. This one chart that predicted the bottom in April is giving us the same exact signal again, and what we're going to do is explain what it is and why you should be paying attention to it. There's a lot in here. It's packed. Let's get to it. Hey everybody, welcome back. As always, subscribe. All these videos are connected. All notifications because they come out at different times. And you'll also find out from the community tab some of the things that I post on there that people only see when they are subscribed. Anyway, let's do it. Let's start with the basics because I think that's where to go, but we're going to jump right into it here because there's a lot to cover. 12, 22, 55. There's the S&P. It's looking right at us. This is exactly what it's doing. It cannot get through the 12. It cannot get through the 22. For just reference, how I look at the market, and the biggest thing for me with these levels is this. The 12 to me is whether or not I even want to put a swing trade on. The 22 to me is whether or not the bulls are in charge or the bears are in charge. The 55 is, do I have institutional support or not? And there are my demarcation lines. So looking at this right now, as we dive into this video and you hear what I'm looking at and how I'm seeing these rotations and how I'm playing it, what things I actually did start buying, I think it's really important to suggest that you have to understand where we're at and what to expect. That you are far from out of the woods on this, but you are seeing some real clear indications here on what the market's thinking. Secondarily, if we take a look at the NDX before we dive into this, you are seeing the same exact setup except one major difference. You are starting to see over the 22 on the NDX and a close over the NDX. And that is giving us color. And why do we want that color? Well, if I take the S&P and I divide that by the NDX, what you're going to get is you're going to get a pattern. And that pattern is really just continuing to drop. We don't want that to rally. We want that to drop. So when we dive into the S&P, we can understand that we do want the NASDAQ to lead, and it is. So is this a precursor or not? We're going to find out, but let's jump into it. We're going to start with the basics, and then from there, we're going to drill into other areas. Now, the other areas that I really want to drill into are not only sectors, but there's a lot of moving between cross assets. So we're going to look at some cross assets as well, because they are kind of giving us some signals. But just start with the basics, and I think that's a really good spot. If we just look in front of us, we're just going to go from July, or really the end of the second quarter, and then see how this is played out. And why I think this is important is because it just gives you a real understanding of what's going on. So is this really anything different from, let's say, the June 30th day over? And I don't think that it's anything that we really have to concern ourselves with, but let's just do the basics and go, all right, well, let's just, and I'm using the body of that trend line here, and then I'm using the next spot where it touches. If you don't like that, you should do it your way. If we look at that area, we can see the battle that's going on here. Now, a couple things that I would say about this that I find fascinating is you're not bouncing hard off of it anymore. You're bouncing soft off of it. That's not what you want. You want hard bounces. Now we're going to blow this up a little bit and go from there. So in other words, bounce off of it, rips. Bounce off of it, rips. Bounce off of it, I'm not going to make that noise again, but you get it. So we're not really got that emphatic bounce. What we do have is we have a lot of undercuts that happened the other day in the S&P and in the futures market, which is exactly what you want. So that doesn't mean that we're not going to hold in here and consolidate, but it does bother me that we don't have this huge run up. And this could be for a litany of reasons. It could have to do with what's going to happen Monday and Tuesday, which we have to go over. It could also have to do with the VIX that's about to expire on Wednesday, which is going to be a huge expiration. And we're going to have to spend some time on the VIX and different ways for you to look at the VIX and how to compare the VIX, because you got a really clear signal Friday. Very clear signal, one that we got in April. And I'm going to show you how you can make that signal yourself on a chart. It's very simple. It's not hard to do at all. And it's very helpful. But if you look at that DTL, downward trend line right in here, you go, okay, I get it. There's the body, bang, bang, no, bang. All right, so are we wedged in? Kind of, but there's something more important here that's going on. But I think it's important, again, to just start with the basics. So if we just do the simplest things and say, okay, well, where are the players at from August 1st? And we could see the players from August 1st, they never really got there. So I don't I don't like doing just the date, meaning I don't want to just do it because it's August 1st and go, oh, look, but that's obviously a pain point. Market's up here. All of a sudden you're stepping into it. We've got this suck salad when you're coming in. It's definitely an area where people got hurt, got out of the market, and then it did nothing but rip. So those people, on average, want to make sure that they stay up on their trade. Go back a little further, and again, I don't want to go too far back, but let's just go to this June 23rd low right in there. And again, what are you saying? You're not even really close to this. So when we're trying to figure out where the average person on these dips is getting hurt, where do we really wind up? Well, we wind up around that August 20th level. All right, so let's get rid of all these so that we don't VWAP all over ourselves. And we'll drop in the August 20th. And then we would say, well, that back test here, September 2nd. Yep, those people too. So the people that bought this dip, the reason that this started acting like this was those people on average started getting underwater. Now, what I think is super important about this when we blow it up, the gap down on and then you have the futures, and then it gaps right back up to that level. The gap down, and then all of a sudden, bam, you're right above it. Now these are starting to become what? They're starting to become supports. And this is where I think it gets super interesting and why it's important. And I want to be real clear about this. I think VWAPs are important, but I think they have a time and place, and it's around pain points. That really means a lot more to me than anything else because it just shows human behavior. I'll give you another pain point on this chart in 1 second that I think that you should be using. But if we're to understand this and what it's telling us, it's, well, those people were underwater here, then they were underwater here, and now they're starting to lift up again. And now these people are coming back into the market, and they're buying that area. And then it tried again, and what happened this time? Those people said, you know what? I missed this dip, and I missed this dip. I'm buying that dip. That is a change of behavior. And I just want to point out that this is what happened at 2:30, dentist's favorite time of day. And it happened on Thursday at 2:30. So when I show you the next chart down the line on the VIX, this is going to coincide perfectly with that. Now, you don't know what's going to happen because you had some really bad news out there with the regional banks. And we definitely have to address that because it's coming Monday and Tuesday. We're going to get way more color on that Monday and Tuesday, and we have to address that today so that you know what to look for. But if we look at that level, those people changed their mind. And I don't think it's a coincidence that we happen to be sitting directly on those levels. I believe in very little with coincidence. And this is one that I just candidly don't believe in. Now, if I do, again, some of the simple things like drop this to a 4-hour, and we get into this solely on the 4-hour and we look at how this is going. We're going to clean that off now. And we've been talking, I've been yammering on about this since, I guess, back here in early October. There's a reckoning coming. And maybe this was it. Maybe this was the dip. I don't have an answer to that yet, guys. And I'm going to be really clear about this. Nobody does. But I've got a lot of signs that, yeah, unless this gets worse, that might have been it. You don't know that at the time, but you're definitely getting signs of it. What I do like about this is I do like that we came down. I really wanted to undercut it. And we just didn't get what I want, which is not a shock in life, right? But look at these levels and how we're acting in here now. So we look at that close on Friday. We didn't have to close like that. Go take a look at the last hour of the market. The last hour of the market, to me, is probably one of the most important parts because it shows you what the institutions are doing, especially the pension funds. The pension funds don't have to buy. They don't have to do anything except honor their charter. So if we always look at what they're doing in that period of time, it's very telling. You can always just drop it to a 15-2 and really dive into it. And you can see from 3 o'clock on, they kind of held their ground, meaning they didn't feel the need to get out of the market. So if the big guys are not getting out of the market on a Friday in the last hour, they're probably not getting out. And that's a very different kind of vibe than what we got from last Friday, isn't it? So you always want to see this. The big corrections in the market, you'll always see Fridays, and it's usually like 2-3 Fridays in a row that just look like a disaster, like a dumpster fire. That's not what we got here. And you can see the difference between last Friday and this Friday. Now we have tariff issues in here. The US was going to have to make its own cooking oil, God forbid. It was going to be a real disaster. But in here, we don't see that happening. And I think that's very important. Now let's get into some of this that's really important for you guys to watch. Number one, the VIX. Everybody knows the VIX. Everybody knows what it is. If you don't know what the VIX is relatively simple. If you just look at this number and think of it this way, whatever the VIX is, if you think about it on an annualized basis, That's what the S&P is supposed to do. There's other calculations to it where if the VIX is at 20, then the S&P should be in like a 5 or 7% range. I don't have the exact numbers in front of me. I think it's 5.8% range over the next 30 days. So when the VIX goes higher, it's telling you that the volatility in the market is going to go higher or lower. That me moving the mouse like this up and down is a signal of volatility. I'm not going to give you a graphic. So you understand why people look at the VIX. It shows that people are buying protection on the S&P or on the index for their stock portfolio. That makes sense. So when it increases, that means you have increased risk. And that's why people would look at this. And that's why they find value in it. I do want to be below 20. I didn't get what I want again, but that's life. Sometimes you just don't get what you want. So I have to take what I've been given. And what I have is I have a heck of a drop, but there's way more to that drop that we're about to go over. But wait, there's more. And I would love something like this. But what's interesting is I actually did get something like this, and I'll show you in a second. But you have to look at it and say, all right, so this is what happened. Now, what do we do about it? And if we just drop into this on a 5-minute, this is what happened all day long. So no matter how we feel about the market, they unwound. Now, why are you unwinding going into a weekend? That's a really good question. I don't have an answer for it. And I do think you're going through sector rotation. We will get to that as well. But why are we doing this into the weekend? Like, of all the times to hold options into the weekend, especially with what's going to happen on Monday morning, you would think that you would want that on. And I believe there's a reason why they did take it off, and we're going to address some of it in a moment here. But more importantly, when we look at something like the VIX and the collapse, there's also other measurements that we can use besides this for volatility. But make no bones about it, they unwound their put position. This is an enormous drop in a very short period of time. Now, in front of you is VXX, and a lot of people may not know this. Some of you will. But VXX is just an exchange traded note, or they refer to them as ETNs, and it takes the rolling position of short-term VIX futures. So the big difference between the VIX and the VXX is that you're looking at one that is really looking at the very short term, and the other one that is not looking so much as the short term. So this is taking that first and second month of VIX, and that's what it's focused on, where the other VIX is not taking that into account. So this was what you would refer to as front-loaded. Right. And the reason that you care about this is because if you know it's front loaded and they're more focused on the front load than they are on the back end, that's going to tell you something. Meaning, if you're more worried about the week than you are over next year. So like, let's say the market drops and you're concerned about an event, but are you still concerned about the economy? Right. Like, that's kind of the way that you should look at it. So the first and second month, it's the rolling. And it's important to understand about this. When you look at this, you're looking at the first and the second month, and it does deteriorate over time. It does decay. So you can't really do long-term comparisons. You can do short-term 12-month comparison, year-to-date comparisons, but you can't go back over years and do what I'm about to show you. Now, on the surface, when we look at this, we're seeing that I have the VIX up here, and then just so we're clear, here's the VIX, and then here's the short-term VIX. And we could see that the short-term VIX trades a little hotter, obviously, than the longer term. But what's important about this is the measurement. And I just want you to just get the concept. Maybe you have to watch the concept a couple times, but you see Wednesday, and then from there, we're going to end right into that on that Friday bar right there. So if we click here and we move over, we're just going to take this bar right here. And you're going to see that that's a 115% move. All right. And then if we do it again on the same bar up here, you're going to see that that is a 48% move. So what happens is that the longer term VIX is moving on a percentage basis greater than the shorter term VIX. So what that means is longer term at this time, they think that there's more systemic risk to the market. Hopefully that makes sense. And what you'll see on this drop in April from here on this one day, we'll try to capture that just one day, you can see a 21% drop in the short term. And then if we went here and looked over, what kind of drop do you have here? Well, you have a 35% drop. All right. So on the longer time frame of the VIX, they think the systemic risk has dropped more on a longer time frame than it has on a shorter time frame. Shorter time frame, there might be some bumps in the road. Longer time frame, we think that we're going to be okay. And you'll remember that this is when the Fed paused and said, or the administration, not the Fed. Apologies. I need another cup of coffee. But when they said, hey, you know what? We're going to pause, 90-day pause while we work this out with our partners. So then you can see how this slows down. And then eventually the shorter term starts catching up to it. Really important to get this because that explains why you're going to have spikes in this next part that I'm about to show you. And this is a great tool. So if someone told you that it was just as bad on Thursday as it was in April, you wouldn't believe them. But the bottom line is the VIX and relative to the shorter term VIX moved in such a way that it was commensurate with what happened in April. And a lot of people don't know this or aren't paying attention to it. As a matter of fact, when I saw it start to happen, because you don't know that it's going to stop here. When I saw this start to happen into this, you have two decisions to make. You either think, hey, it's probably going to stop here, or hey, this is about to get a heck of a lot worse and there might be another shoe to drop. There's way to determine that on the long term and the short term. But before we even go down that road, and we're not going to do it in this video, the bottom line is that's an inflection point. And when I'm at inflection points, I tend to get out of the way. So into Thursdays and Wednesday, those kinds of days, I'm reducing. Just on the equity side, I'm reducing. I want out of the way because I don't know what's out there. And we're about to cover that in a second. But what we did was we actually got to the same level on April 7th when we had all that liberation and winning and then we stopped. So if we look at where we're at now, yeah, you could have bottomed because essentially what's happening here now is the longer time frame is unwinding faster than the shorter time frame, where before the longer time frame was cranking up into this. Now you could always drop and go higher. You usually don't get, and you can only go back so far, and you'll see what I mean by the deterioration, but you really don't get that many double dips of this. In other words, it's very rare when you're up in this level to see something like this where you're going to hit it and then go, or hit it and go. Not when you're up here. So when you look at these, it's very hard to get a false signal. Could you get one? Yes. What I would be doing is if you see deterioration in this market again, I would look at this level very carefully. I'd mark it off. I might even set an alert on it and say, hey, if it gets over this, if things start getting bad and we get over this level, I need to watch. And that's exactly how you can calculate it for yourself. And now you understand the mechanism and how it's calculated. It's a really good tool on trying to understand what's going on in the market. And really what you're looking for are those extremes, but just understand you cannot go back through time because as I explained, the VXX deteriorates. I did a lot for some time in this video to go through some of the shorter term moves and how I see things playing out. And I think it's a good time to just kind of also get a snapshot of that Friday. So we're tying Friday's market action actually into what we just saw, meaning, hey, the VIX, this is happening. We peaked. What are they rotating into? So a lot of people think you're going to rotate into the usual suspects. That's not usually the case when this happens. So if you go back and look at April, what names started exploding? What were the names they had to buy? What I would suggest that you do, and the reason that I'm showing you this is a lot of people are going to go back to the usual suspects. What tends to happen here is you want to find the names that started breaking out and hitting new highs. And we started seeing that. We started seeing certain sectors, one in particular, that really started getting a lot of attention to it. We're going to get to that in a couple minutes here. But what I tend to do on Fridays, like let's say there's a bunch of names that I have an interest in. If you're in the community, you already know this. We did this live, so we knew where to put our chips. But what we saw happen very early on was this drop. And now if we look at those drops, it was these kinds of names down here. Now Wolf stood out and that was the one that they had to buy. So if you go through all these names here, you didn't see them have to pile back into IREN or gold or ASTS or APLD or any, and even if you look at some of the sectors I put in here, and I just did this for a snapshot to show people what was going on. No, they were out there, they were buying Meta, Google, Apple, Tesla, and Wolf obviously stood out by the end of the day. And here you are just looking at the futures. So you want to buy anything that's obviously outperforming the actual index, because why would you buy something that's underperforming the index? That would just be silly. Just buy the darn index. And you can do things like this on inflection days. And the reason I'm showing this is because it's applicable. You could just do this and say, oh, on an inflection day and go, oh, okay, well, what do they have to rotate into? And it became pretty clear over time what they were rotating into that day. And we're going to get to that in a second, but there's a couple things I think we need to address first. The first thing I think we need to address is what's going on with KRE. And I think this is super important. If we look at KRE here, it can't get out of its own way. And we would look at KRE for a second in this chart and say, well, I get it. This is what's happening. It's definitely something I need to pay attention to. But what's really happening here? Do I really have to get involved? Not really, no. And this is, to me, where it gets even more interesting, because if I look at something like a KRE, and then I look at this and compare it across the board to something else, like what I like to do is I like to do a lot of relative comparisons. I find a lot of value in that. So if I look at KRE versus the SPY, for example, I haven't had to do anything for really a decade. So I keep going to these names, waiting for them to catch up. And candidly, versus the SPY relative performance, it's just not working. And even if we go back to the 23 level, it's still not working on a relative basis. Now, the question really is, are we at some kind of trough valuation at that 23 level and that we bounce from here? So when you look at these charts on a relative basis, it's always important to understand what you're looking at. So is this something I want to be involved in? And what I mean is, if I went from here to here, okay, that's 37%. Now, that's why it's so important to understand the relativism of these charts and these numbers, because you might look at this and go, well, if I hold in here, that means for a short period of time, regionals could outperform. Yeah, that's a decent sized move. If I could catch this move, then yeah, that's something I'm interested in. And this is where the rub comes in with it, because when we're looking at these longer term timeframes, you have to figure out who you are. Are you someone that's trying to catch these shorter term moves? Are you someone that's trying to do this longer term kind of play? That's where this all stems from. So yeah, when you're down in this area, this is definitely something that you want to take a look at and see, is there something that makes sense here? And we're going to find that out going into Monday and Tuesday. So where this leads us to, and I'm going to put them on the same chart because it looks like they share the same brain, but Western Alliance and Zion and the news that came out, and if you haven't seen this news, it's pretty significant, because they took a big hit, and they took a big hit over a loan. And so now you have a situation, you see how, I mean, it's almost, that's why I put them on the same chart. It's like crazy how much they're just trading alike. I think that this is super telling, because when and I'll take one off now just so you get it, so we don't have to talk about both. But I think this is super telling, because what it's telling us is that this news comes out and then it just stops dead. Now, you should have had follow through on this. Hands down, should have had follow through on this. And it just stopped. It's my belief that going into the quarter, which you're about to go into, that the majority of the street, this one's on Tuesday and Zion is Monday morning. And that's what I'm saying. We don't know what Zion says, because the whole reason that these companies even admitted to what was happening with these losses was because Jamie Dimon said something. And if Jamie Dimon didn't say something, would we have been aware of this, or would we have walked into some kind of suck salad Monday morning? We don't know that. Now, an important note, these companies usually have earnings. Usually earnings are Monday morning, and they're going to do the afternoon. It's kind of interesting, because most of these regionals just get it out of the way in the morning, because it's usually not that big of, it's not usually that big of a deal. But I do think I do find it interesting that they're doing it in the evening. Anyway, we do have the day, it looks like, before they come out with their earnings. So that's going to have some positioning going into that. But I do think you want to watch this, and I do think you want to see what they have to say. Now, analysts came out and rallied around this and said, hey, it's only one loss. But on the heels of what we saw with Tricolor and Jeffries on First Brands and these losses, and we can see how these things are selling down, private credit companies like AERS, all of a sudden, these areas are becoming a big place of concern. And that's going to lead us to looking at something else in a second here. But I really think that this is very important for us to understand, that there is this cloud, and this cloud is not just China and tariffs. Is the consumer having a problem? That's one side of it. The other side of it is, are corporations having a problem and unable to pay their bills? And if that's the case, then it's a problem. Now, for Western Alliance to come out and say something, and for Zion to come out and say something, what I thought was really interesting was, I don't know that they were saying anything unless Dimon said what he did about wherever there's a problem, there's more than one problem. He referred to it as cockroaches. Where there's one, there's many. And that usually is the case with this. There usually is more behind it. So these conference calls are going to be absolutely fascinating. What I thought on Friday, and there I go again, using my brain and thinking, I thought RF was excellent, and they showed no cracks whatsoever. And it's important to stay with this theme for 1 second. The stock did not rally on that news. So my first initial response was, this is going to be a problem. Then look at DPST. DPST did not make a lower low. I thought it would. It didn't. So that's telling you that they don't see the need to panic into the weekend. And they also unwound what? their VIX trade. So if you really thought there was systemic risk to the market, if institutions truly believe that, they're not unwinding that trade. They're adding to that trade. And that's not what they're doing. And then we would go and say, okay, well, what else did we learn? Because Ally came out with earnings, and Ally is more lower end credit consumer. Your auto loans, oh, well, they beat by 14%, right? So all of a sudden, these concerns that we had were a little bit alleviated by what we saw. And then you could also refer to what happened with American Express, which just absolutely crushed, raised prices on one of their cards. And we can see how this is acting out right now and how it's going. Matter of fact, if we look at this, for the end of the world or this rollover that we're supposed to have, well, people are still using their Amex points, aren't they? As this thing hit, I believe it's at an all-time high on this name. Let's just double check that, make sure nothing crazy ever happened. Yeah, but you're at all-time highs, which is just absolutely insane if you think about it. And we're supposed to be worried about the consumer. So then they come up with these new terms like K economy or this. If there's not money out there, there's not money out there, right? I get it. We can all talk about this branch of the consumer or that branch of the consumer. And we have seen the cracks, don't get me wrong. We saw it with KMX, and we're waiting to see what's going to happen here with CVNA. Right? But if we stay with this kind of whole thought process, maybe it is the lower end or the car business that's struggling because people are getting these 144-month car loans. And frankly, I think people are looking at it, not just that they can't afford it, but I actually think people are looking at it and saying, just give the darn car back. So we're going to make this full circle. Do we need to get involved in the carry at SPY trade in the reverse? I think if you watch Monday and Tuesday's earnings and that comes out and that's fine, and then you go into Wednesday where you're unwinding the VIX, I actually think that that's going to be a really critical time for the market between Monday, Tuesday, and Wednesday, specifically for the rest of the year. Because if Zion is asked the wrong questions or WAL is asked the wrong questions and they can't answer them and they can't explain how this stuff got on their books because they're saying, oh, it's fraud. Well, where's your underwriting department? Like, that's not making me feel warm and fuzzy just because you're saying, oh, well, they weren't honest. Well, how do you not know that? And what else don't you know about that's in your books? See, that's the rub. But you're not seeing a systemic break to the market at all. Matter of fact, when we look at high yield, which is a great way to look at this, let's talk about what to look at. So in front of you is just HYG. Now, HYG is really simple because HYG is just high yield. And if high yield runs into a problem, then we have an issue. And if you can't borrow on the high yield side or the private credit side, you have an issue. We're going to start with the basics, but I'm going to leave these moving averages in, and then I'll explain it in a second. You see how you're coming down here and then you reversed on Friday? You didn't have to do that on Friday. It wasn't necessary. Why are they buying bonds on Friday? And I think that this tells us a lot. They're buying the high yield market on Friday. We'll get to one other thing in a second here, but I think that this is super important for us to understand that that's what they're doing. Now, I use these averages a lot, and there are just a bunch of averages, and you can use it as well. I mean, it goes from 10 to 300. And the reason I do it is it paints a photo for me on what's going on. And here's a great example. When we cracked up here in 01, and you can see it's September, you started seeing signs of this. Now, sometimes I find it helpful, and I like leaving them all on because it paints a photo, but I can actually just get rid of the actual thing itself and just look at the moving averages because you can see the battles going on, and then you can start seeing when they give way. And if you start looking at like December right in here, you can start seeing the battle, and the battle's lost, right? It breaks this one major moving average, and then these just start cratering and spreading. And that's what happens in here. You can see these little battles going on. So when we go back to something like this now, you could say, oh, well, this is really bad. It's not really that bad. No, like when we get into this area, you can see how we cracked right here. And when we go back and look at this in regards to April, we're hitting that level and then we're testing it and we're getting over it. And then we got more winning. Some cardboard came out and then bam, we got slaughtered, right? We're not getting this. We're not really over these. And these are all colored for a reason the way that they are. If you've been watching these videos for some time, you know that usually I put red when I use like different moving averages, red, yellow, green, for a reason. Because they tell me what I should be focused on. But when this red flips up top, that means to me, I need to stop, right? So whenever I see that, now you're going to see it changes colors in here, but there's a reason why I have that there for the inflection. So if that happens in here and I go from yellow, which is really going to be that caution, right? Okay, that's fine that I have the caution up right now, and you'll see that that one actually stays that way, but there's the white up here. That's the more shorter term. But what I'm looking for is if that red gets up on top, okay, I might have an issue here. So I have to keep watching it and I have to get through that. But we're nowhere near where we were with any of this, even in the past in December when we cracked or anywhere else in there. So they are not selling high yield. Now, another way of looking at high yield and trying to understand what they're doing is just to look at move. And what I will do here is I'll get rid of all these moving averages for a second. And move is to the bond index what the VIX is to the stock market. And if we look at this, what's it telling us? Well, they didn't buy more insurance on their bond portfolio on Friday. So how worried is the market really about this event? And maybe it doesn't have enough data yet. And maybe it will get worried. Maybe it will be an issue, right? But right now it's not. And we can see this if we take a look at the US Treasuries. What they do, they actually were selling bonds because the yield's going higher. So they're actually selling bonds on Friday. So they're not, where's the rush into this? There isn't. And we'll get into the deficit in a second because I think it's really interesting what's happening in the country. And I think we have to pay attention to that too. So if we look at this, it's really hard to see that they think that there's systemic risk to the market because people will say, oh, we need to go and take a look at putting money in other areas. Let's talk about other areas very quickly here and not waste a lot of time on it. This is the whole world index versus the S&P. I'm not saying there's not pockets to invest in. I'm not saying that you don't want to look at things like this because if I measured from here on up, I'm going to get like a 17% return from this area. And for time's sake, we're not going to go down that road. We're going to talk about where you should be focused on. Pockets. So one of the pockets that we keep talking about is defense spending. So when this market comes in, like it just came in, defense spending, that's not going away in Europe. It's only going to get bigger. And you're seeing that with some of these names, like Leonardo has been one that's been all over the place. They sold down the other day because of some news. But this kind of stuff, it's just not going to go away. It's only going to get stronger for defense because of the amount of money that countries are going to have to spend to defend themselves. And these are not small increases what Germany's doing and Japan's talking about doubling theirs. It's not small money. So you can find these pockets, and then you're also going to find pockets like this with Deutsche Bank, and all of a sudden Deutsche Bank's getting smoked. Why? Because everybody's saying, oh, well, this contagion from this regional bank is going to spread to Germany. Okay. How's that going to work out? I'm not saying that it's not going to work out, but when you start to see this kind of stuff happen, you have to look at this and go, am I really truly seeing cracks of this, or is this presenting an opportunity? Now, when we look at financials, and this is something that I'm watching very, very carefully. I'm going to flip to XLF real quick and just hop over for one sec. This isn't great. No, this is not what you want to see. The financials looking like this, it's not great. And we don't want to lose the financials. I can't really find a time where the 12, 22, and 55 are starting to point down and things went well for the S&P. So it makes me wonder, are they going to rotate back into tech, or is this a sign of things to come? Does this fix itself after some of these earnings come out on the regional banks? Because that was the concern. And I don't have the answer to that. Here's what I would say. You want to watch XLF and see if this gets better or if it gets worse. Right now, that's not great. So if I had to point something out technically that's not great, that's not great. And I'm going to just give you two very quickly that you should be watching like a hawk. Hood and this movement, because now they're going to get in the predictive market. You know what I don't want? I don't want my IRA where I'm going to do my bet on the Eagles. Like, I mean, call me nuts. Maybe that's like old school. I don't know. But it's crazy to me that people think about it the same exact way. I don't know how that's going to go. I do know it's bad for some other companies. But to me, the ones that have ran the most that are in the space are Sophie and Hood. If financials get better or worse, they're your proxies. Because if people want to own a regional, they want to own Sophie because Sophie's growing like a beast. Like they really have it together. Hood on the other side of it has really got it together. You know, they really took advantage of what happened with Schwab. But if this stuff comes home to roost, they're the ones that they're going to get smoked. If this bounces, they're the ones that are going to bounce the most. So using those as proxies for the XLF makes a lot of sense. Now, if you're just a long-term kind of guy, you know, then you just buy your JP Morgans and your Goldmans of the world and you go to sleep. But even those, if we really look at what's going, Goldman closed below the 55. Goldman is not closed below the 55 to here. And what people always say to me when I do this, they're like, well, you just said things look like they're going to hold. They do, but that doesn't mean that they're going to. So you always have to look at the full picture and say, okay, well, where's my thesis going to be wrong? See, so many people are trying to find confirmation bias and go, well, what's going to prove my thesis right? People that have been in the industry for a very long period of time do the exact opposite. They go, well, where am I wrong? What is going to happen? I'm going to be wrong. So like if financials start deteriorating, you have to realize like, hey, maybe we aren't going to bounce, or hey, maybe we're going to go sideways here for a little bit. Because if you don't have a strong financial and banking system, you have an issue. Now, we could look at some other things while we're on this little road. XLC seems to be holding that 55. And we did see some of that when I showed you that first chart where we could see that Google's breaking out here and Meta's breaking out. I'm getting a little ahead of myself, but let's go with it. And you're seeing Meta, there's a 700 put wall there that is like, I don't know, made of like Wolverine's bones. Like you just cannot break the darn thing. So it's really impressive how that's just hanging in here no matter what the market's doing. And I do think that you're getting rotation into the Mag 7. And if we really look at what the market did in the S&P, Apple didn't break. These names did not crack. Right now, does that look great? Does that make me feel warm and fuzzy? No, because you're rolling over and like these are stacking on top of one another, right? So we do have issues on some of these names that they're just not great at all. And we can see that. Let's clean this all off for a second. AWS, we can see how it's rolling down. And anyone can see the left, head, right, but that's a weak head and shoulders, right? Because the right is very weaker than the left, but it's still there. Like they don't look perfect. But then that goes again, and let's get back to it and go, all right, well, where do we go with this? Well, here's the IWM versus the S&P. Like I keep hearing about this return and yeah, sure, maybe we'll have a bounce in it, but do I really want to be in the IWM over the S&P for the past 3 or 4 years? Probably not. Probably hasn't been the best trade. Let's look at gold versus the S&P. And this is where I think it gets super interesting because you're back to that April peak. Now that April peak was a low in the market, wasn't it? And here we are again. So are we putting in that bottoming in the market? Because this, if I'm going to use this as an indicator for that, is tell me that. But watch when we go over to this one. If I go over here and go back for decades, this level is pretty darn significant. And I think it's worth bringing up. So if we just take a look at this, let's blow this up and then we'll pull it here. If you just look at this area right in here, every time that we're in here from Feb 16 over for the past decade, what's happened? We've gotten into this and then we've kind of rolled over and S&P took over versus gold. So yeah, this is something to look at. And there's another part of this too that I think is really important. And I had a huge gold position on. I closed it. We made like $50 on it. And I could be early, but I'll just tell you exactly why I did it. And I do think I'm early because I don't mind being early on this because I don't want to be around for it if it happens. You're 20% or were 20% over here on GLD from the 55. I use a 55, a 12, a 22. You should use what you're comfortable with. I don't have anything that even registered on that except for this in 06 where I was over that amount and that marked the high. So you're getting to that level where it's just you're so overextended. And to be clear about this, let's be real clear about this when we go back and look at this 2006 again. All it did was come down from 2006. And then from here, a year later, all it did was then take out that high. So if you're willing to wait 12 months and come down from the 70 level down to the 54 level, and you're fine with that, cool. I'm not cool with going from 395 or 396, wherever I sold it, to 338 and tell myself it's okay. It's not okay. I don't like that. So I don't do that. If you like that, then that's what you should do. Remember, all this is information education. There's a couple other sectors I want to get here, but there's some really good charts that I want to show you because this is really what people are missing. So one of the things that I want to do besides the gold comparison, and I'm not going to do the gold Bitcoin thing, you guys do whatever you want. They're actually trading in tandem. But we can see this with the small caps and the Russell. All right, well, let's go look at this. Well, this is small cap, NASDAQ small cap, and I'm giving you the symbol that I use here relative so you can do it for yourself. And if we take a look here, what are we saying? Well, from 25 on, small caps were getting smoked. And then April hit. And then all of a sudden, April's getting better. Well, why is the small caps getting better versus the NASDAQ 100? A lot of it, if you want my opinion, has to do with the health of the US. And people are like, oh, the US isn't healthy right now. The IWM names, 15.9% of them are financial services, regional banks. And we just went through the problems that they're going through, and we just looked at that chart. So you have a huge weight on the IWM that a lot of people just don't talk about. And that's why I always tell people to understand what they're looking at. But when you understand why this is happening, it's because rates are going down and the health of the US economy, despite what people are thinking, is actually getting better. And this is really interesting to understand. Now, I clipped this and I thought it was fascinating. U.S. budget deficit edged lowered for 2025 as record-setting tariff collections help offset what we are also supposed to be unprecedented numbers for payments on the spiraling national debt. This is the Treasury Department. Treasury officials estimated Thursday that the dip in the budget shortfall will bring the ratio of deficit to gross domestic product to 5.9. We haven't breached 5.9 since 2022 and generally runs around 3%, except in times of economic stress. So the goal is to bring that back down to the 3% level. And then Bessent came out and said, noting congressional budget office estimates the deficit would be below 6%. We're on our way. So despite what people are saying and despite what the news is saying and all this crazy stuff, what you have is you actually have the deficit being lowered on a percentage basis, which is very good for small cap names. I think where people are losing it a little bit is on the small cap side, is not understanding that it could be the technology names that are in the NASDAQ that are going to do better. And that is where I think that the focus should be. Now, that along with IWC, a lot of people are looking at this micro and they're getting excited as it's breaking out. This is where we hit last time. So again, if I could find things here that, hey, you might want to pay attention to this. This is where IWC hit last time in 01, or 21, 22. And we kind of ran into a problem. So are we running into a problem again? Did all these little micro caps get too frothy? So what I like to do again is I just like to do comparison. Now, in this case, I'm going to take the micro caps and I'm going to divide them by the NASDAQ 100. And this is going to give me an understanding on a relative basis on where I am. And I think that's going to put things in a little bit more of a perspective, that you're not even close on a relative basis to the IWC, to the NDX. So then I would say, all right, well, what about the IWC to the S&P? Is that anywhere near where it was before? And it's not. So what is this telling me? Well, it's telling me that the IWC on a relative basis to what the S&P has done isn't even close. So that would mean that this signal here is not commensurate with where it is over there. You might want to watch that part again. It doesn't mean that it's right and it's definitely going to break out. But what it does show on a relative basis, that how we were frothy over here with microcaps previously is not even close to where we are here in regards to what's going on out there right now. And that in and of itself is really important. Now, one of the most important things that I see out there that I can try to instill is that these macro changes, when we think about the stool, and we have the macro, the fundamental, and the technical for those that don't know the stool and how I view the world. I'm not going to draw one right now, but I think that this is really interesting because this guy's actually doing some of the stuff he said he was going to do. And I don't know why we're so surprised by that, but fast tracking drug approvals for rare diseases. And we started June 5th with this kind of concept. And then we come into October 17th, FDA awards 9 companies new national priority voucher to speed drug reviews. This is super interesting. And of course, you want to look at those names that are on there, and we're going to touch base on this. But none of this has anything to do with tariffs overseas or the AI bubble or what's going to happen with interest rates. Interest rates, yes, to an extent, because it does move biotech because they borrow a lot. But under the Prescription Drug Free Users Act, FDA has 10 months company files to review the application. So once you do this, they have 10 months. They can compress it to 6 months if you win a priority award. And what they're saying is, well, that's just the difference between them actually taking it out of the pile and reading it or not reading it, which is kind of crazy when you think about how many people work there. The new National Priority Program is meant to move evaluations along more quickly. Multifunctional teams of physicians and scientists, tumor board, develop cancer patients through selections, don't guarantee approval. It does speed the process. Get it out fast, reducing idle time where applications are just sitting around and not being reviewed. I think that's really very important. Of the awards announced, the first 2 batches. This is very important language. The awards announced Thursday are first of 2 batches. The second, which could be announced in a few weeks, they come amidst the backdrop of recent resurgence for biotech stocks, which have been aided by deal making. But it's really the positive data that we're starting to see come out. And I just want to go through this because this is the one sector of the market that I just don't really think is getting the attention that it deserves. Now, some of these names, I'm just going to give you a flavor of it so that you can see it for yourself. But something like RVMD was named in that. And then obviously you can see how this stock is acting in here. It's acting very well. You're also starting to see people start playing those pot names a little bit more. PRAX, which I had some great trades on this week. This thing just looks absolutely fantastic. They did the secondary. It was oversubscribed. And now you're closing at all-time highs. People are like, oh, I missed it. It's really going to just get this out there. And if you remember one thing from this video, remember this. Out of all the IPOs from 2018 to date, only 5% are going to go up over 10x. Only 5%. And out of those, 80% of those will 20x. So when you find the ones that actually move, they're the ones you want to focus on, not trying to go find find the new one. And you can always see this kind of follow through later. Take a look at MLYS for a great example, where it came out, very positive data, and then they just keep grinding higher. Why? Because it's so rare to get through this process. Another great example is this INSM. I bought this for a day trade of all things at 116. And you can see now this got me out of it. And here on the swing, because I just held a portion of it, I just kept going higher and just kept moving the stop up. But look at these names. And this is after the data is released. You see, people seem to think with these kinds of names that when this announcement comes out that it's over. Far from it. That's when larger institutions step in. Why? Because larger institutions hate uncertainty because they have large swaths of capital and they can't get in and out of the market like us. So they like that certainty, and then they'll buy it predicated upon the certainty. So we're starting to see some of these names really start to take off. And I saw this with XBI. Now, my issue with XBI was this movement on Thursday. And I'm not sure that it is more of a sector play, or where I'm really thinking of going with this is the individual names. But we are seeing this space lift. And I do think also, if you start looking at the MSOS space, that's starting to get a lot of attention. A lot of other names, such as the ATAI. I know guys are playing this one because of the mushrooms. I'm playing this one. I have a position in this, just disclosure. But I think you're going to start seeing some approvals, maybe some consolidation in the space. I'm not sure how they're going to play the whole pot thing out, but I do think that it also falls into the thing of what we just talked about with the deficit. The goal with the deficit is very clear. It's to outgrow our spending, not to cut the spending. We tried that. It didn't work. Or they tried it very briefly and it didn't work. So they're looking for the next thing. And getting this into the system makes a lot of sense, because then all of a sudden you're going to just have banks that are going to have more revenue, more streams of income, more tax revenue, et cetera, et cetera. And I do think that this is where it's heading. So those kinds of names that have already moved, I would continue to look at. And that's one area. You could also just go through IBB and look at the names yourself and tear them apart. Remember, IBB is more concentrated than XBI, but no one's really getting into this sector. Where I would want to start waning from, not that it's not going to work, but when you come out of any kind of correction, and I know people are laughing saying, well, that's not really a correction. Actually, it is a correction. We're going to clean that off for a second. Actually, considering what you've had, yeah, this is about as bad as it's gotten. I mean, we really haven't had a drop of that magnitude if you really look at this chart for a period of time. And these were nowhere near as bad as what they were. You had this that happened July 31st, but really in here, like that's the biggest drop that you've had in a long period of time. You get a reset to the market. And what do I mean by you get a reset to the market? So just stay with me for a second, because it doesn't mean that you don't buy these names, but understand that they fall out of favor because you start seeing what they're going to buy. So like, for example, space phones. If I clean, I'll clean all this off for a sec. So if I clean all this off, we know we have a wall up here. We know we came back, ASTS, and we know we sat down here in the day, and the put wall is like $85 or something. But this didn't come roaring back. Was not one of the names that came roaring back. If you look at something like IREN, you didn't come roaring back. So you want to go and look at your charts on Friday and say, what were the names that on that dip, they just had to get in right away. And you can start looking for it. Like, oh, geez, was it gold? No. Was it the UFO names? Not really. Okay. Was it quantum names? Did they have to get in quantum names? Not really. And so you're constantly cycling through and you're trying to figure out where they're positioning themselves, because this will really tell you what you should be focused on, because people will be looking at uranium and going, oh, now's the time to get back in. Not if it looks like that. Like maybe a couple days from now. But what you'd want to focus on, it goes, well, what happened with the XBI? Well, that didn't really lift either. And then you go IBB. Okay, well, IBB and those names, which is more concentrated, that actually closed at a new high. How many sectors are closing right now at multi-year highs? Not a lot on Friday. So by diving into it and doing that kind of minutia, you'll start noticing things. You'll be like, oh, well, that's interesting. Why did XLRE close at a new high on Friday if people are so worried? It doesn't make sense. How about XLF? Yeah, that closed at a new high. They took it, or XLV, I'm sorry. Yep, they took advantage of that dip and they bought it. How about consumer staples? Yep, they started buying some of the consumer staples. This is painting a picture that's a little different than when you just look at the XLF and what's taking place there, which couldn't even get up off. So you are seeing rotation. that rotation does present opportunity, but don't discount what moved and rallied very hard on Friday and what didn't, and just equate that to the options market and people getting out and repositioning. Some of that is just institutional rotation into sectors that they think are going to outperform into fourth quarter. And if you sleep on that kind of stuff, you could miss significant alpha. That's it.